Good morning, John. Good to see you. We're recording this video on Wednesday morning, and with 30th of June coming up, it's as good a time as any to review the first 6 months and perhaps cast an eye over what we think the next 6 months might hold. John, just to provide some index returns over the first 6 months, the S&P 500 has returned 15%, whereas the NASDAQ has returned something like 18%, but the Dow only about 5%. And Australia's key benchmark, the ASX 200, also has returned only about 5%. That seems a little bit disappointing that we're so far behind the S&P 500. What are the key themes that you think have emerged over the last 6 months for the year to date?
Well, I think the Dow and the Australian market, and probably European markets, which have given similar returns, are probably representing mainstream economy. Yep. And then you've probably got the NASDAQ and S&P being overweighted to the new economy. So I think that explains it. Now, the question is whether the new economy is worth what the NASDAQ markets are saying they're worth. And the only way you're going to find out about that is in the future looking back. So that's the problem we've got. Very hard to analyse speculation and put a value on it. It's great when you're on the right side of speculation. It's terrible when you're on the wrong side. And we've seen recently NVIDIA in particular go up and down 5 and 6% in one day, which tells you that the valuations are not certain. You go from what I think is a passive valuation on stocks where everyone can see that's the fundamental baseline, and then you have a speculation element or a story element. Is there a story, and then people buy the story, buy the speculation, and that's where stocks, and if they go too far too quickly, then you get into hyper volatility. So that I just make that point. So that's the worry, and when you're comparing portfolios to markets which have a significant risk or speculative valuation, then if you're taking a 20-year view or 10-year view to get returns, it's quite difficult, and it's probably not a fair comparison. If you want to be 100% in NASDAQ, you've done well, but there's going to be a time when you're going to do very badly by doing that. So it's a trading market, I guess, at this stage. But the rest of the world is just growing slowly, as we know. Inflation is coming off the boil. We get an inflation reading this week in Australia. It will show that services inflation is still there. So wages are now coming through on the cost of doing business and being passed on in through prices. We saw that last night in Canada, where they had a disappointing inflation rate. Just 1 month after cutting interest rates, their inflation's picked up. And the interesting thing is 40-odd% of that inflation, which was not forecast, or 40% of the inflation was the cost of living, dwellings, so rent and mortgages and that. So the cost of living in a house, So, and I think Australia's got the same problem. We're going to have this recurrent theme that rentals and mortgages, servicing costs are going to hold inflation higher, but outside that, we're probably going to see inflation trending down. Now, the question is, how does the Reserve Bank interpret that? Yeah. I still maintain if the cost of housing, I know I'm cutting across a whole lot of issues here, Paul, it's not really any question, but if the RBA reacts to inflation caused by the cost of dwellings and the cost of rent by putting up interest rates, which can only have one effect of putting up the cost of servicing a loan, whether it's an investment loan or a mortgage, then you're actually adding to inflation. And I don't see that being understood in any mainstream media, that there's a point where interest rates actually add to inflation. And that's where we're at, I think. And I think Canada must have known underlying inflation is coming down, but the headline inflation is holding steady because of those factors. So get right back to your question. I think markets probably ran too hard, particularly American markets, expecting interest rate cuts based on inflation coming down. There's a more persuasive argument actually in America for interest rates to come down than anywhere else in the world. And that's because their interest rates are so far above inflation. But I've said this over and over again. We just have to wait and see when that interest rate cut comes, because it's a certainty. It will come. It won't go up in America. It will come down, but we just don't know what's causing the delay. Is it political? Is there some other information we don't know about? Are they scared about the American dollar devaluing quickly on the back of an interest rate cut because of imported inflation? I don't know.
Mm. So just to summarise a few of those themes that you mentioned, the first one, the rates have been and are going to be higher for longer compared to how we've beginning of the year. I guess the second thing is that AI has certainly dominated market narrative over the last months. And that obviously has a much greater presence in the US market than in the Australian market. But we have seen quite a good performance of the bond market with 10-year treasuries and 10-year Australian government bonds, both sitting around 4.25%, which is kind of better than we might have thought a few months ago. And I guess some of the other surprises of the last 6 months: US economic resilience, a poor performance out of China, and the non-recovery of their real estate sector. And perhaps in Australia, that the consumer-facing side of the economy has been somewhat weaker than we might have anticipated. Do you agree with some of those conclusions, John?
I think I agree with all of it, Paul. Very astute. I think you're covering all of this very well in your quick bites, which I think we're getting very good feedback on. So if anyone's not getting those quick bites watching this video, please let us know. But they're all issues which are now past us to some extent. I think a lot of the things you're talking about correctly analysed the last 6 months, and I've got to work out that they're going to continue into the next 6 months. Of course, that's speculating on the future.
Yeah.
As you say, the revaluation of NASDAQ is really through AI developments across numerous multinational companies, and they're all racing and investing heavily to get on front of that curve. And there are beneficiaries, supply beneficiaries in that market, and there are technology beneficiaries and intellectual property beneficiaries. So they have all cylinders firing, and you go across to Europe and Australia and go, well, what are you guys doing? And the answer is not much. Not much is happening. So it's more basic companies fronting the consumer, and the consumer right around the world is aging. They're changing their consumption patterns. Australia has a benefit because we're immigrating younger people, and we're holding up our population growth, and our demographics are much better than anywhere else. And we can massage our demographics through immigration, which Europe can't do, and Japan can't do, and probably to an extent North America is struggling with that issue of immigration and who they immigrate. But Australia's perfectly positioned. But that's why I'm confident about the growth outlook for Australia. But you can't be as confident about the stock market, because the stock market, in many respects, doesn't reflect the opportunity, because it's a market which is excessively exposed to financials and resources. And so the 40% of what's left in the market is a bit of a grab bag. And a very interesting article yesterday in the AFR talking about the building sector, which has had a downturn, but you just know it's going to surge because of the immigration and the government assistance. And we've got industry funds talking about building to buy or renting to buy. Some significant investments there. So the builders are going to be, the building supply is going to be quite a strong part of the market, but you can't buy them. They don't exist on the stock market. So, so we've created an investment climate for us, for Australians, where the growth opportunities are not there. Now that takes you into, or should we be searching them out in the unlisted market? And that's a much bigger, different debate. But it's interesting to look at it and go, well, we're not doing the best thing, and we should be encouraging companies to stay public, not discouraging them.
Got quite a few political events about to occur overseas, mainly. We've got the French election, I think, on Sunday, first round, and then we've got the UK election on the 4th of July. I think it's the French election that is concerning markets, because it looks like President Macron has, called this flashy, this quick election, very short run up to it, in response to the European parliamentary elections. And it looks like the far right and the far left are both making inroads, and that Macron's party will actually, come last. And that could cause a lot of tension with the European partners, particularly Germany, and France's bond rate is starting to reflect that. Is this something that you're particularly concerned about? Do you think we're heading back into a similar environment that we experienced with Greece, when their fiscal problems got totally out of control and really distorted what the the Eurozone had to deal with there?
Well, look, I take your point. I think it's probably more an issue for Germany. I think because France is the second largest economy and they're very close to Germany in terms of supporting each other's economic policies. You do note that all these markets in Europe are all in one currency. So if money flees France, either in the bond market or equity market, it goes into other markets. And you notice some buoyancy, particularly in Italy, which is the third largest economy. So they've been quite a buoyant market, And so I think the risk of a euro issue is not as significant as, I wouldn't put that in the significant. In terms of the risk to the French stock market, you'd have to say a swing to the extreme left would not be good for the stock market for obvious reasons, and to extreme right, I'm not sure. The bond market does reflect uncertainty, and that's fair enough. Again, an extreme left move would not be good for bonds. Extreme right move, again, I say I don't know what that means. The overarching issue is that the Central Bank of Europe, European Central Bank, is controlling everything to the benefit of everyone. So if they have to put an action plan in against the French bond market, I just believe they will. Hopefully it won't be necessary, but issuing of currency, quantitative easing, is still in the bag of tricks by central banks around the world. So I think if people are expecting extreme volatility in the bond market, I'd probably say that's not a higher risk as volatility in the equity market in France. But as you say, the polls are there, so bets are being taken in the stock market. So you'd have to say, if the bets are, and the polls are saying a certain thing, it's really you're betting against the poll going the other way or not being right. If Macron got back in, for whatever reason, then you might have a surge, confidence surge. But anyway, it's sitting in Australia. I'm not an expert on France.
We've also got the first US presidential debate between Biden and Trump on Thursday night. So that'll be interesting. I don't think it'll be riveting viewing by any means, but who knows what the November election holds for the US. But probably
it'll be dominated by who's a felon and who's related to a felon and who's a father of a felon and who knows a felon, and it really is pathetic. But again, it just plays out. I think the beauty of it is the market knows that one of them is going to get up, and really, are they that excited by any? So I just don't. I really do think it's a sideshow, and really the parliaments, so to speak, of the US run the place, and I guess the administration will be more important. The quality of the administration. And I saw an interesting commentary yesterday about one of Trump's proposed advisors saying, well, we can solve the Ukraine war by saying to Ukraine, if you don't start negotiating, we're going to cut your support. And Russia, if you don't start negotiating, we're going to go for you again, in terms of embargoes. So forcing them to the bargaining table. And given everything else has not worked, in a strange way, you think, well, that's probably not a bad idea. You know, if America's, you know, has the ability to, because having meetings in Switzerland without the other side attending is interesting but useless.
Yeah.
You've got to get them in the room, and you know, and I'm not. You just got to force them to get in the room. It's a terrible situation, and I just reading the newswires this morning. It just gets worse and worse about the bombardments of cities, which doesn't seem to concern anyone. I just think they've devastated probably 1,000 square meters of land in Ukraine, which is almost unlivable now. For what purpose? You know, it's got to stop, and it probably needs a heavy hand to come in and stop it. So I'm not promoting Trump. I'm just saying, well, maybe the Biden administration or the American Parliament should bring that in on a bipartisan basis. You know, start thinking about solutions rather than fighting.
Well, I think on that note, we'll have to call time. So we'll be holding thumbs for a good CPI number in 2 so, and hopefully.
But you'll cover it. You'll cover it on Quick Bites anyway. So if anyone,
cover it on Quick.
I think we'll put your quick bite on the inflation straight under this video on Friday, so people can see what's happened.
Great, thanks, John, and we will see you next week. All good.
Great, thanks. Bye.